So you still believe it's going to hit $1 million?
Yes, we do.
Do you even have in mind the time frame that you think that it will hit $1 million by then?
So what we've been saying, our bull case has been 1.5 billion.
Yes.
But we're seeing stablecoins usurp one of the roles of Bitcoin.
Yes, exactly. You just mentioned that.
Yes, in the emerging markets especially. So maybe $1 million is more our bull case.
It's going to slow it down a bit, you think?
Yes, I do. Our base case is roughly 750,000.
Wow.
So from 150 and 120,000, we still have a nice way to go. And we think that will happen by or sometime in the next 5 to 7 years.
7 years.
In today's deep dive, we decode Cathie Wood's macro thesis on why the global monetary system is quietly pivoting away from traditional anchors, and why Bitcoin stands at the center of this transformation. Wood highlights a critical but under-recognized trend: China reducing its U.S. Treasury holdings from $1.2 trillion to roughly $700 million, signaling strategic diversification away from dollar reserves. Yet she argues the market is misreading this shift. The explosion of dollar-backed stablecoins, now nearing $300 billion, acts as a counterbalancing force, creating parallel global dollar demand outside traditional sovereign channels. In her view, this dynamic blunts the de-dollarization narrative and reinforces dollar primacy, particularly in emerging markets. At the same time, she identifies a historical inflection in gold valuation relative to US M2, reminiscent of the 1980 inflation peak, supporting her thesis that gold has likely entered a topping phase. Against this backdrop, Wood positions Bitcoin not as a substitute store of value, but as a superior technological monetary system.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
What's happening right now, we know that countries like China are taking down their dollar reserves. They've taken down their dollar reserves from 1.2 trillion to roughly 700 billion. And they seem to be continuing. I don't think the trade battle has helped change that. At the same time, we're seeing the rise of stablecoins. Stablecoins have accelerated to roughly 300 billion. And we think stablecoins, the largest of which are Tether and Circle mostly in the United States, Tether in the rest of the world, they are backed primarily by Treasury securities. So again, they're dollar backed. So we think this is going to offset a lot of what China has done in terms of dropping reserves. In terms of gold, we have analyzed the market value of gold to M2 in the U.S. And we use the U.S. because dollar is the reserve currency.
Yeah.
There are only 2 times that ratio has been higher. One was in 1929, 1930. That was the Great Depression. And gold was a flight to safety because banks were going out of business, and there was a lot of contagion in the banking system. We don't think we're in that environment. The second time it reached this level, a little above this level, was in 1980, at the end of the great inflation started in the 1970s when the U.S. closed the gold window in 1971. And what happened after it reached that level? It then proceeded to decline for years. Why? Because the flight to safety or the hedge against inflation was no longer needed. We think this time is going to be more like that time. So we would not be surprised to see gold peak out in the near term. And yet cryptocurrencies, we think, will continue to move forward because they represent not just an asset class, but a technology. And in the case of Bitcoin, a new private, digital, rules-based, that's the most important phrase, rules-based monetary system.
So you still believe it's going to hit $1 million?
Yes, we do.
Do you even have in mind the time frame that you think that that will hit $1 million by then?
So what we've been saying, our bull case has been 1.5 billion.
Yes.
But we're seeing stablecoins usurp one of the roles of Bitcoin.
Yes, exactly. You just mentioned that.
Yes, in the emerging markets especially. So maybe $1 million is more our bull case.
It's going to slow it down a bit, you think?
Yes, I do. Our base case is roughly 750,000.
Wow.
So from 150 and 120,000, we still have a nice way to go. And we think that will happen by or sometime in the next 5 to 7 years.
7 years. I'm going to go back to gold because it's very interesting what you said. So in your mind today, gold is an investment, a hedge, or a saving?
So gold is both a store of value, as is Bitcoin. Gold is a hedge against inflation, as is Bitcoin. It's also a hedge against deflation, counterparty risk, as is Bitcoin. But it is not a technology the way that Bitcoin is. If you think the Bitcoin blockchain is the layer of the internet that the developers in the late 80s and early 90s did not build. And they didn't build it because they never dreamed that commerce and financial services would take place on the internet. Think about that. That was a long time ago.
Yeah.
In fact, everybody was saying, I'm never putting my credit card on the number on the internet. Well, that changed quite a bit. In the meantime, we've had to use instruments like credit cards and debit cards, but no native currency. Now we have a native peer-to-peer currency, so we can take a lot of the middlemen out of the equation, and that's very important.
So if you had to choose as a safe haven for the coming the next 10 years, will you go for Bitcoin or gold?
Bitcoin, hands down.
Quick round. I'm gonna ask you quick questions. I want you to pick one and tell me why. So gold and Bitcoin, you said?
I said Bitcoin.
Bitcoin. And for dollar or euro?
Dollar. Most people think the dollar is in decline. And it did have its worst year, the first half of the year, since 1973. If we're right on the fiscal policy, our corporate tax rate, given one big beautiful bill, OB3, our effective corporate tax rate, including the depreciation measures, we think is down to 10%, which is roughly the lowest in the world. And our deregulation, from very high levels of regulation, our deregulation is moving very quickly. We think the returns on invested capital are going to go up relative to those in Europe. So we'd bet on the dollar.
Wood's most powerful argument centers on Bitcoin's dual identity, asset and technology. Gold, she explains, has historically operated as a hedge against inflation, deflation, and systemic risk, roles Bitcoin now also fulfills. But unlike gold, Bitcoin introduces programmable final settlement financial rails, effectively functioning as the monetary layer the early internet never built. This native peer-to-peer system removes transactional intermediaries and unlocks global capital efficiency. Consequently, Wood reiterates her price trajectory, a base case of around $750 million per Bitcoin within 5 to 7 years, with a bull case historically pegged at $1.5 million, now modestly tempered to $1 million, given stablecoin adoption in emerging markets. Beyond crypto, she emphasizes structural drivers supporting the US dollar and US equity markets, from favorable corporate tax policy to regulatory liberalization. She sees China's AI advances as a competitive accelerant for US innovation, not a secular threat, and even signals opportunistic re-entry into Chinese equities due to depressed valuations.
Since we've mentioned this race also between China and the US, when you look at what China did when it comes to AI and deep tech,
Yes.
do you think of it as a threat or an opportunity? You are an important American investor for you and other American investors.
Yes. Well, I mean, you can think of it as a competitive threat.
Okay.
Now, there's nothing like competition to get us going. And now we have regulations coming down and tax policies supporting innovation. across the board. We had our hands tied behind us on nuclear policy, on rare earths. I didn't know until recently that in 1980, our regulators in the U.S. Declared that the waste from rare earth mining was nuclear and was to be regulated like that. No wonder we don't have rare earths. That is changing.
Yeah.
All of that is changing. So I think China has capitalized on our regulations increasing over the last 25 years. Now it's a game on. So, and we're very impressed with what they've done in AI as well. DeepSeek was a moment, right?
Yes.
It was a moment. And even Sam Altman and Jensen Huang in the United States complemented the algorithms that they introduced. Now they're open weight models, so now we can use them, which is very interesting that we're having all of this angst about chips, but not about the software. That's very interesting.
True.
So I think we're getting closer to striking a trade deal. And, you know, from a national security point of view, I understand that one of the primary roles of any government is to protect its nation. So I think we let our defenses down also. And so those are going up. But that doesn't mean that this competitive threat is necessarily bad if the shackles are off of us now, and we think they are.
Of course. The last one, I know probably the answer, but I'll ask it anyway. U.S. stocks or China?
You know, it's very interesting. We moved out of China in 21 completely, and we've just started moving in because the valuations are so low there.
Okay.
If we get a trade deal, I think the valuation gap will close, or at least close somewhat. So I think Chinese stocks are going to do pretty well. The risks are higher, though, because we've seen Xi Jinping, one of the reasons we moved out, there was the nationalization of online education. They did banish some of the greatest tech entrepreneurs, and that's not a welcome environment for innovation. So there are risks, and I think there are more risks there than there are in the United States. But the valuation gap is so large that I think China's going to be a very good place to invest.
Amazing.
If I had to choose between the two, if you're a foreigner and you invest in the U.S., you'll get the U.S. upside and the currency upside.
Amazing.
So,
amazing. Okay, last one question. If I have $1 million, I don't, but let's just assume I do, and I trust you, where shall I invest? Where would you advise me to invest?
Okay, I'm not an advisor and I'm not allowed to give advice. I know what advisors would say. Make sure you diversify. Don't put all your eggs in one basket. But what I will say is most portfolios are short truly disruptive innovation. They think they have innovation because they have the Mag 6 or the Mag 7, right? We think the amount of innovation taking place away from the Mag 7 is going to deliver returns that are going to be twice as good. So if we're right, and this we have in our big ideas 2025, if our research is correct, and that's a big if, but if it is, then companies involved in truly disruptive, technologically enabled innovation are going to deliver returns that are in the 40 to 50% range at a compound annual rate because of the super exponential growth that we expect. We think that innovation in stock market indexes, the broad-based ones, will go from roughly 30% now to roughly 80%. So we think innovation is going to grab the lion's share of the appreciation going forward. So don't be short truly disruptive innovation. Make sure you allocate enough. It's more risky, but with higher risk comes higher returns.
Ultimately, Wood frames the coming decade as a regime shift where true disruptive innovation, not merely the mega-cap tech cohort, captures market alpha. She anticipates innovation weighting in broad indices rising from 30% to 80%, driven by exponential technologies spanning AI, blockchain, and deep tech. In portfolio terms, her message is clear. Most investors remain structurally underallocated to breakthrough technologies, and this underweight represents systemic opportunity cost. Bitcoin and digital rails serve as the monetary foundation of this next cycle growth engine, just as the dollar remains globally ascendant. The takeaway for sophisticated crypto and macro investors? Gold's role is stagnating, fiat dominance is evolving, not collapsing, and Bitcoin is transitioning from speculative asset to core financial infrastructure. As capital flows realign toward innovation and decentralized systems, Wood asserts that the highest returns sit where technological disruption meets monetary reinvention. In her words, don't be short the future.